In financial news today, global brokerage firms have shared their views on the Indian equity market as of April 2026. HSBC has upgraded Indian equities to overweight, projecting the Sensex to reach 94,000 by the end of 2026, indicating a potential upside of approximately 10%. The firm believes that India presents better value compared to Chinese markets and notes a recovery in earnings. HSBC highlighted that bank margins are expected to expand, and consumption sectors, particularly automobiles, will benefit from GST cuts and lower interest rates. They also mentioned that India is well positioned to attract renewed emerging market inflows as global investors shift their focus beyond AI-driven markets. Goldman Sachs has also upgraded its stance on India to overweight, reversing its previous downgrade from October 2024. They have set a target of 29,000 for the Nifty by the end of 2026, suggesting a potential upside of around 14%. Goldman Sachs identified finance, consumer goods, defense, and oil marketing as their top sector picks, citing key drivers such as RBI rate cuts, easier liquidity, and tax adjustments. However, they acknowledged risks related to profit misses or global shocks. Citi has taken a cautiously positive approach, reducing its Nifty target for December 2026 from 28,500 to 27,000, lowering the target multiple from 20x to 19x. They warned that 3 months of supply disruptions due to the West Asia conflict could reduce India's FY27 growth by 20 to 30 basis points, increase inflation by 50 to 75 basis points, and add billion to the current account deficit. Nomura has adopted a bullish stance but recently cut its December 2026 Nifty target by 15% to 24,900 from 29,300, citing the West Asia war as a risk to energy supplies and consensus earnings. They see a 10 to 15% risk to FY27 earnings estimates if oil prices remain elevated. Nonetheless, Nomura views a potential buying opportunity if the Nifty declines by another 5%, noting that valuations are at the low end of the 4-year range. Lastly, UBS remains underweight on Indian equities, stating that valuations still appear expensive relative to the fundamental performance of companies, despite India's trajectory to become the world's third-largest economy by 2028. This content is for educational purposes only and not investment advice.